Hi, my name is Chris Tuck with SJK Wealth Management. I'm joined here today with Scott Kleiman.
Hi, everybody.
He's our founder, portfolio manager, advisor. Myself here, I'm a partner at the practice, also portfolio manager. And we're starting our podcast.
And your financial planning.
Yeah, so we're starting a podcast series. And in this series, we're going to do a lot of things. But mainly, we're going to be talking about current market events at a high level, and how they might be affecting our clients, their portfolios, the decisions we make here. So we'll be talking about current events, but kind of bigger, high-level stuff, not maybe something that happened in the news yesterday.
Right.
Kind of bigger concepts that are going on. We're also going to bring in a lot of our partners, people that we get advice from. So that might be accountants, attorneys, other business disciplines, to get their opinion on how some of these things might be affecting their businesses. Their clients, could be affecting us and the way we think about planning, just to get that other expert opinion in there. So occasionally we'll have a guest as well. Yeah. I'd like to say from the beginning of this is a new experiment that we're doing to have more communication with you, our clients, and let us know if there's concepts or topics that you'd like us to talk about. You could shoot those to Lindsay. You have her email address. It'll be there in the description. And so if there's anything that you think you'd like us to talk about, please shoot those ideas over. As for today,
what's our topic?
The first thing we're going to talk about is, I don't know, Scott, if you saw, but one of the big kind of news stories in the last week was Goldman Sachs article about their expectations for the S&P 500 for the next 10 years.
I did see that, and I know we both have some opinion about it. So what do you want to talk about?
So this article came out, they're kind of what we call capital market assumptions, which a lot of the major firms do and kind of expect what asset classes will do for the next 10 years. And Goldman's was kind of shocking, and everyone talked about it because their expected returns for the S&P 500 was 3% a year on average for the next 10 years, which is pretty low, at least historically. And they cite a lot of sources for this and why they're doing it. They use things like the CAPE ratio. We'll talk a little bit about that, what that means. I'm basically saying they think there's a 72% chance that bonds will do better than stocks in the next 10 years. So I don't know, what do you think about that?
I don't agree. That's basically it. I don't agree with them. I mean, they have a lot of research in this area. We look at research outside of them. I do think there will be periods of 3%, but I don't think averaging it out to 3% a year is really going to happen. And it's something we're going to talk about, which is innovation. Yeah. I think just that innovation is going to probably make that not correct. Yeah. I'm hoping it's not correct, but I have some broader thoughts. I don't know what you're thinking about with it. What are you thinking?
So I went and I looked and said, all right, well, Goldman's saying 3, and their range, they always give like a standard deviation, some tolerance. So their range was negative 1% returns for the next 10 years to 7, average 3. So I looked at, like, what does JP Morgan said? Their average was 6. What did BlackRock think? BlackRock had a range of 4 to 9.
Wow.
Vanguard has a range of 3 to 5. So, look, they're all guessing. It's the future.
It is.
No one's telling you what's going to happen tomorrow. They just don't know.
Yeah.
Right? And especially 10 years from now. And I think a lot of this work is done based on valuation. And when Goldman was kind of pushed on this, so first off, let me just I think this should be labeled as FUD. Right? Fear, uncertainty, doubt. Let's get some news out. Let's get some.
Say that again. What is it?
FUD.
FUD. But what is it again?
FUD Ruckers. Fear, uncertainty, and doubt.
Okay, I like that.
So I think they put this negative piece out there to kind of get people talking about it. And then when they were pushed on it a little bit more, it wasn't really necessarily just valuations. It was concentration that they were talking about, which we've been hearing a lot about lately. And that's that the 7 largest companies in the U.S. have resulted in a large majority of the gains in the last 2 years, and really for the last 10 years. So a lot of the returns are so concentrated that the indexes, because they're market cap weighted, meaning the biggest companies get the biggest percentage of weighting, that the index is kind of lopsided, that you have these massive returns in just a few names, and the other 493 companies in an index like the S&P really haven't done much. So them talking about what these returns are going to be are more of a critique of concentration. So we've been looking at that here at the practice. What do you think about that?
Yeah, no, I think you're spot on. I think these 7 companies that have been the heavier weights in the index and actually driving the market won't last forever. And I think you alluded to it a second ago, where you made that direct statement that it's going to spread out I do see the market spreading out from the top 7, and I think that equal weighting is going to be more important.
Yeah, so equal weighting meaning you have the same percentage in all the companies in an index as opposed to a lot in just a few.
Correct, correct. But however, and again, we're going to talk about it a little bit, I think innovation drives everything.
Yeah.
So I'm not 100% convinced that it's going to spread out all the way, but I do think that it is going to spread. And there's going to be new companies that are leading innovation. So it's a tough one, but I do think it's going to spread out as a bottom line.
So we're labeling this Goldman piece as FUD.
Yep.
And we're going to say
FUD.
There's a lot of things that can go. Who knows what the next 10 years are going to hold?
Yeah.
Diversify. Make sure you know what you own, right?
Yeah.
And then also, as we're talking about, is innovation, right? So how can you
Yeah.
possibly understand in the next 10 years what type of innovation is going to be around? And that could have huge impacts on growth.
Absolutely.
Right? For better or for worse. But we're seeing so much news about innovation lately. So the big thing, obviously, everyone's talking about is AI. That's driven a lot of the results this year. And we're seeing some pretty cool things happen with AI. And one that I thought we could talk about was like autonomous driving. That's really... I think there's a disconnect between what's happening, perception and reality. So we have companies like Tesla that are trying to solve it with a software solution, right, using their cameras and feeding AI. And then there's companies like Waymo. It was a subsidiary of Google that is using more of a hardware solution, software as well, but a different way to do that. And they actually have autonomous driving working right now.
Isn't that working in like Phoenix and California?
Yeah, so it's deployed in Phoenix, San Francisco. They've started in LA and now Austin as well. Most of the miles have been driven in Phoenix and now San Francisco. But I was looking at the stats earlier. 22,000 miles driven with no human. It's just someone sitting in the back or no one in the car at all. The likelihood of a crash is a fraction of what it is with a human driver. So over the 22 per, I think, million miles, their average accident was half an accident every million miles driven, whereas human drivers were averaging close to 3.
Yeah, definitely.
But also, and see a lot about it in the news, but you go through their report, in the accidents, they also give a delta of the speed change in that accident. And they reported how many, when you have a very low delta, so your speed doesn't change very much in accidents, it's probably a very minor accident. So under a 1 mile per hour change in speed in that accident, it was almost half of them. So you have, a sixth of the accidents happen, and even of that sixth, most of those are very, very minor incidents.
Yeah.
So they're pushing this safety thing. It's happening. There's 22 million miles that have been driven in those cities. You can order a driverless car, and what kind of growth that could create if we have. Think about, you press a button on your phone right now to get your food and someone has to go pick it up and they drive it to you, and now just some car shows up with nobody in it, and cost savings there, obviously disruptions in the industry.
Yeah.
There's so much going on in that space. What are you saying? What are you thinking?
Well, I'm seeing a lot of the same things you're saying. I do see a little bit, I do see some infrastructure challenges. I still believe that. I mean, I know they're doing it in Phoenix and they're doing it in, obviously, the state of California.
Yeah, Phoenix is very boxy.
Yeah, I mean, I can't imagine it in Manhattan. I can't imagine it in Philadelphia.
San Francisco streets are tough, though.
I know. But again, though, I think it's amazing. I think it's coming. It's not a matter of is it coming. Right. It's a matter of when. But I think, I know, like if we go back to Tesla, as you were talking about, they're trying to solve it with software. Right. Personally, I think it's going to be more of a hardware-driven thing. Obviously, software is going to be involved, but the hardware is a lot quicker. Yeah. The software takes interpretation, it's time. But, as an example, one of the things I read about, I think it was over the weekend, that Tesla took 300 lines code out of one of their programs, which had to do with autonomous driving, that they were able to remove because of AI, 300 lines of code. Wow. Now, obviously, that code, when a program is looking through it and then executing, it's really quick. I mean, you're talking about milliseconds. But if you remove a lot of the code, it's quicker. So it's past my pay grade, actually, where Tesla's going to go. But just to turn it a little bit, but we keep it on Tesla. And again, we're not recommending anything with Tesla. We're just talking about Tesla, and Tesla is more than just cars. As we know, it's SpaceX, it's the self-driving, which is with cars. It's about their battery innovation with their new 4680 batteries, that they're making them more compact, more energy able to come out. They're cooler, cooler meaning temperature-wise. So I think there's...
It's not just like cooler.
No, not just cooler.
Tesla's all about
and I know you like that, what's the truck, the Cyber truck? I know you like that. That is cool, but it's not too good looking. But I mean,
Beauty's in the eye of the beholder.
Right. That'll only get better, you know, as it is. But I think as a technology company, Google, Tesla, I mean, that's just where it's at. Yeah. And it just doesn't affect them. It affects another topic that we'll get into, which is when we get to like banking innovation.
Right. Yeah, I mean, Tesla's just so set on this software solution, and the profit margins are just going to be insane, most likely, if they are able to produce this with software. And then think about the deployment there. You can basically deploy that to any vehicle versus a hardware solution where you have to retrofit that, and it's expensive and higher margins.
But Chris, I think you're spot on though that it's going to be here sooner than I think, because I gave you a number one day. I don't remember what that was, like 10 years out, then it'll be all over the place. But I do know I don't know if it was Sweden, that said by 2035 they will not allow any more gas operated.
Yeah, I mean California as well, right? Yeah.
I mean it's coming, so they're being forced.
But the autonomous driving is going to be interesting. There's obviously going to be a moment in the future. It's going to be here. They're really focused on the safety side, so we got to wonder: is there a point where they say, "Hey, you know, it's like smoking. You know, it's really you shouldn't do it. It's bad. Like don't drive your car. Like it should drive yourself." I mean, that'll be an interesting moment. But I do think, as far as AI is concerned, that most likely, if Tesla does solve this, if they really find out an AI solution with software to solve for autonomous driving, that is a critical moment in humanity, in investing, that like there is a real, right now we're using ChatGPT and we got these agents and like, hey, what this could be, but you know, nothing too crazy that we're doing. I mean, we see where it can go. But if they can crack that with an AI, I mean, it's such a pivotal moment. I think it changes everything. So,
well, if anyone can crack it, I think it's them.
Yeah. So, I mean, as far as speaking about innovation, Scott, you had saw a story about on the banking side. So sticking with the theme of innovation, a different type of innovation, but on the banking side, things that are coming, and specifically interview with the CEO of Santander and some things they're doing, which I think speaks to more of a global and U.S. Change in banking and what people are doing. So you want to talk a little bit about that?
Let me just give you some highlights, and then maybe you could comment on it as well, and maybe pull in technology to it as well. But I did see, I think it's Anna Boten. I don't know if she's a CEO. I think she's like an operating partner at the company. And again, we're not giving a recommendation when we're talking about Bank Santander. It's just a story that I saw that was really interesting, where obviously Bank Santander is a large global bank, where most of their banking is in the UK, Spain, and now Latin America and Mexico. So I just see this bank as really on the cutting edge of innovation. They're using a lot of AI on their platform, but what they're doing is they're trying to morph into a digital bank now. I mean, obviously they have the brick and mortar banks. They still have them in the US, I believe. But an interesting thing with them is 50% of Latin America citizens, people that live in Latin America, do not have bank accounts. 50%. And Bank Santander is there to change that digitally. It's easier for them. Bank Santander, again, being one of the largest banks. In fact, in America, they're the 5th largest auto loan lender, which I never knew. So I think that another thing that Santander did is they bought Open Bank. You may know a little bit about that. But Open Bank is going to open up a lot of things for us in America with them, and also in, call it cross-border banking. You know, U.S., Mexico, Anna was talking about. It's just, I think, unbelievable where a bank with a global footprint can really go with the innovation and their money that they're throwing at technology. Do you have any thoughts about that?
Yeah, I mean,
and it's not just Bank Santander.
Right. So I think, you know, we've seen a shift in the last couple of years of online banking, specifically like high yield savings accounts, where your traditional brick and mortar banks were paying such a low rate. Even the brokerages, honestly, were paying very low rates on money markets, on savings accounts, and then your high yield competitors were paying much higher because interest rates went up. Obviously, we went through that in 2022 with inflation, but interest rates coming up, the return that you could get was much greater if you went to these online banks. We were looking at 4 or 5%, sometimes even greater. And I saw the Open Bank that they're going to start at 5.25%. Now, who knows when? I went on earlier today and put in my zip code, and it's not unavailable yet. But so who knows what that rate will be?
Yes, we don't know.
The Fed is saying that they're going to, and they have started to lower interest rates.
Yep.
But we see it's just still surprising to me that a new client comes to us and we see they have a lot of money in cash. They were scared, or maybe they feel like they need a large emergency fund, or whatever reasons it might be to have that cash, but it's earning nothing. They have it just sitting in a savings account that's getting a very, very low rate, like less than 1%.
I can help answer that.
Yeah.
Gray hair, my generation,
Right.
and little generation before me, we're so used to the traditional bank.
Sure.
And that is changing.
Yeah.
That is changing.
I love how the banks, when you go in, they have the vault.
Yeah.
And there's nothing in there.
Just lock boxes now. Yeah. It's changing.
They're not actually holding your money. And I think one of the things with Santander, they're going to try and they wholesale their auto loans. And it's actually cheaper if they bring them in-house. And I think that's one of the things they're looking to do is, they can give you a higher interest rate if they're also loaning this money out. And that's how the bank works, right? They take your deposit and they loan it out at a higher rate than they give you. I mean, it's just how banks work in general. So if you're paying 8% on a car loan and they're paying you 5.25%, the bank's still doing pretty well on that. They're
real
picking
well.
up the difference. Obviously, there's defaults and all the things that go into that. But I just think it's interesting that a lot of people have this cash, and there are solutions out there. They're easy. You still get FDIC insurance. It is a savings account, and things that people should really be exploring if they're not utilizing that. Maybe not for all of their cash. You still need money in your checking account, for example. But just missed opportunity there.
Yeah, there really is.
We've also been looking at, as interest rates come down, that and if they do come down, maybe thinking about locking in some of those rates with moving into bonds and CDs and other things that might be able to lock that interest rate up for a longer period of time. So for now, thinking about using those money market funds or high yield savings accounts to get the rate that's there. And then if you want to have that maybe for longer, thinking about locking that into some type of fixed income instrument.
Yeah. Everyone should look at their own situation, speak to their advisor, and see what's best for them. But, before we wrap this up, Chris, I'm thinking as we're talking about this, and you brought it up, AI. AI actually finds itself in everything that we're talking about.
Sure.
Every little bit of everything.
Yeah, I mean, it's making companies more efficient. I mean, think about going back to that Goldman thing with the 10-year outlook. It's like, imagine doing the 10-year outlook before the internet comes out and becomes mainstream. Like, how could you have possibly known?
Yeah, you wouldn't.
Right? And how much it changed productivity, how much it increased margins, all the things that did. The fact that, and then the iPhone, right? Now we can do email from our phone, and just all these innovations that just change everything. And I think we're at another moment with AI. So trying to project what the returns are going to be over the next 10 years with this very big change coming in technology that we're seeing. I mean, there's real applications that are happening, and it's just going to continue to speed up. So I think keep an open mind. Keep your options open. Keep diversified.
Look for opportunity.
All the normal stuff we always talk about anyway, right?
Yeah, things really don't change.
No.
You just have to be on top of it.
Right.
So I think we talked about good topics. I hope that everybody likes the concept. Chris, you want to wrap it up?
Yeah, so again, we'll be coming to you on these podcasts pretty regularly. Again, if you have ideas of concepts that you want to talk about, our next podcasts are going to be with some guests talking about tax, talking about estates, all different things that could affect you and your plan and your finances. So please stay tuned. We hope you find this content engaging and informative. It is for educational purposes only. None of the companies that we mentioned today are stock recommendations in
None
any
at all.
way. So thanks for joining us, and we'll see you again next time.